Welcome. I'm Isaac Meekum, and courtesy of the Utah Valley University's Planned Giving Department, we are excited to host this online workshop focused on IRA planning for baby boomers webinar. As Utah's largest public university, Utah Valley University is committed to serving the community through accessible education and student success. We appreciate the community members and alumni who serve our students. We hope this workshop will help inform and inspire you as you plan your future retirement. This seminar is part of a series focused on important financial topics, presented by professionals in retirement planning, estate planning, taxation, finance, and investment management. During this webinar, your video and audio features are disabled to create a focused learning environment. At this time, I'm honored to introduce our esteemed presenter, Nathaniel Evans, who will provide you with valuable insights.
Welcome, everyone, and thank you for coming this afternoon. Today, we're going to be talking about what's likely to be one of the most important retirement questions you'll ever make. What should you do with your retirement money, like a 401k, 403b, or similar plan, once you leave your job? A lot of people mistakenly think that this is an easy choice, but that is rarely the case. Depending on your particular situation, you may have up to six different options to choose from. So today, we're going to talk about each one of those six different options so that you can make the best decision for you and your family. We will also shed some light on some common mistakes so that hopefully you can avoid them. Before we do that though, let me tell you a little bit about myself and my company. My name is Nathaniel Evans, and our mission at Keeler Thomas is to give our client families the gift of time by guiding them to attain what matters most. We accomplish this through our comprehensive wealth management solution, which is the creation, selection, harmonious integration, management, and accountability of an entire team of professionals needed to deliver the outcomes that matter most to you. So now that you know a little bit about me, let's talk about the six rollover options when you leave your company. Depending on your circumstances, you may be able to 1. Leave your employer plan assets in your existing company retirement plan. 2. Roll over plan assets to a new company retirement plan. 3. Roll over your plan assets to an IRA. 4. Take a lump sum distribution of your plan balance. 5. Convert your plan assets to a Roth IRA. Or 6. Make an in-plan Roth conversion of your plan assets. In some cases, you may be able to combine some of these options on this list. For example, you might decide to convert some of your plan funds to a Roth IRA and roll the rest over to a traditional IRA. The first option, and the most straightforward of the possibilities, is to leave your retirement funds in your current plan. If you choose to do nothing, you are essentially choosing this option. Of course, there are a number of reasons why you might intentionally leave your money at your plan too. Most of you will have this option available to you. There are a few times when a plan will force you to take a distribution. If you're lucky enough to be retiring early, or if you've otherwise left your former employer in the year that you turn 55 or later, you can take penalty-free distributions from the plan sponsored by the company you just left. This is different from the general rule, which says you have to wait until you're age 59 and a half to take penalty-free distributions. Once you're 59 and a half or older, this is no longer a concern. Similarly, certain federal, state, and local public safety workers can take penalty-free distributions from your plan at age 50 or later. If creditor protection is a significant concern for you, that's another reason why it may make sense to keep your money at your plan. Certain plans, like most 401ks, offer creditor protection under the Employee Retirement Income Security Act, a federal law known as ERISA for short. ERISA offers very strong creditor protection and safeguards covered funds from the reach of most creditors. On the other hand, IRAs, Roth IRAs, and plans that don't receive creditor protection under ERISA receive creditor protection under state law. Thankfully, most states provide these retirement funds with creditor protection that is roughly equivalent to the protection provided by ERISA, but that's not always the case. You should always be aware of the fees that you're paying in your current plan and the difference, if any, of the fees you'll be paying if you move your retirement money elsewhere. Fees vary greatly from plan to plan, but in some cases, Your plan may offer certain investments at lower costs than you can get elsewhere. Of course, the opposite may also be true. A rollover to an IRA or other retirement account could help lower your fees. You simply have to look at each of these things on a case-by-case basis. And of course, it's important to consider the value that you're receiving in conjunction with the fees you're paying and not just the fees themselves. Of course, no solution is going to be perfect all of the time, and just leaving your money with your old employer is no exception. There are any number of reasons this might not make sense to you, some of which you can see here. Okay, so far we talked about why it might make sense to keep your money in your current plan, but many people choose to move their plan money elsewhere after they leave their job, either to another plan or more commonly to an IRA. So before we talk about why that could make sense for you, let's talk about how to move retirement money. In general, there are two ways you can move retirement money from your plan to another retirement account. You can move it either indirectly, which is known as a 60-day rollover, or you can move it right from your plan to your new retirement account, in which is known as a direct rollover. A direct rollover is generally the best way to move your money. Let's see why. In an indirect rollover, you receive a distribution of your plan funds payable to you, or they are sent to a non-retirement account. Then you have 60 days from the time you receive your distribution to get it back into another retirement account. Now, 60 days may sound like a long time, but it can go by in what seems like a blink of an eye. Let's face it, life happens and people get distracted, sick, or we simply forget. And if that happens and you miss the 60-day deadline, that distribution is taxable, and depending on your age, it may also be subject to an additional 10% penalty. Even if you're on top of things and you complete your rollover within the 60-day window, there's another problem with most indirect rollovers. When Congress created the plan distribution rules, they wanted to make sure people didn't take their money and run. So they created a special rule that requires plans withhold 20% of taxable distributions that are payable to you when those distributions are eligible for a rollover. For instance, let's say that you have $100,000 in your plan and you request a distribution for the entire amount. Your plan will actually send you a check for $80,000 and will withhold $20,000 of your balance for federal and income taxes. Now suppose you take the $80,000 and timely roll it over. Have you completed a full rollover of your plan distribution? No. Even though you only received $80,000 from your plan, $100,000 was actually distributed. If you want to complete a full rollover and avoid any taxes on your distribution, you'll have to both roll over the $80,000 you received and make up the $20,000 withheld from your other savings. And what if you don't have $20,000 just lying around? Well, that's just too bad. Just imagine if your distribution is larger, say $500,000. In that case, in order to complete a full rollover, you'd have to come up with a whopping $100,000 to make up the amount withheld for income tax. Let's look at an example. John requests a distribution from his plan on May 1st. On May 2nd, the plan sends him a check, and on May 10th, John receives the check in the mail. John has 60 days from May 10th or until July 9th to get his distribution back into another retirement account. John has $100,000 in his 401k plan and requests a distribution of the full amount. John's plan will send him a check for $80,000 and will automatically withhold $20,000 for income taxes. If John only rolls over the $80,000 he receives from his plan, he'll still owe tax on the $20,000 that was automatically withheld by his plan. In order to make a complete rollover and avoid any taxes, John must timely roll over the $80,000 he receives, and he must make up the $20,000 withheld from other savings. As you can see, there are some real problems with indirect rollovers. Thankfully, there's generally a better way to move your retirement money, and that's through a direct rollover. In a direct rollover, your plan money is sent right from your plan to your new retirement account. Most importantly, there is no 60-day time limit to worry about, and there's no mandatory 20% withholding. Sometimes, though, a plan won't offer to send your money right to a new retirement account. They do, however, have to allow you to make a direct rollover. Typically, this is done by providing you with a check made payable to your new custodian. For example, the check might read Company X, Custodian, for the benefit of John Smith IRA. If the check is made payable to your new custodian like this, your distribution can still qualify as a direct rollover and get the same favorable tax treatment. There is no 60-day deadline and no mandatory withholding. That's true even if your plan sends you the check and you have to forward it to your new custodian. All right, now that we understand the different ways you can move retirement money, let's go back to exploring your rollover options. If you go back to work for a new employer that also offers a retirement plan, you may be able to roll your old plan funds into your new plan. Note that some plans don't have to allow rollovers from other plans, so if this is something that appeals to you, be sure to check with your new plan to see what the rules are. The reasons to roll your money into a new employer plan are generally the same reasons you might consider leaving your money in your old plan, such as the potential for stronger credit protection, the possibility of purchasing life insurance with plan funds, and the possibility of lower fees. If this sounds like a lot of maybes, and it is, when it comes to plans, the tax code is often far more liberal than a plan's own rules. So a lot, as mentioned before, varies from plan to plan. In addition to the benefits we discussed before, there are a few other reasons why you might roll your old plan funds into a new plan. One reason is if you need to take a loan from your retirement money. In some cases, you may be able to take a loan of up to $50,000 from your employer plan. In contrast, you cannot take a loan from your IRA. That's known as a prohibited transaction and comes with some very scary tax consequences. In fact, if you had $1 million in an IRA and borrowed just $1, your entire $1 million would be considered distributed and fully taxable to you. Another reason this could make sense to you is if you want to use your retirement money to purchase life insurance and your new plan allows for it. To be clear, this is where you purchase life insurance while your money is still inside your plan. Life insurance is a prohibited investment in IRAs, so you cannot roll life insurance over to an IRA. A more practical reason you may roll your money from an old employer's plan into a new plan is to simply consolidate your accounts. Many people, as they get closer to retirement, try to simplify their lives. Rolling over money from your old plan to a new plan means one less account statement to keep track of, one less beneficiary form to keep up to date, one less account to make sure appropriate RMDs have been taken, well, you get the point. Once again, this strategy is not for everyone. Since this is a very similar option to our first option, you'll notice many of the potential disadvantages are the same as the slide I showed you earlier. The third option you have when you leave your plan, and one option that must be available to you, is a rollover to an IRA. This is the preferred option for many when they leave their employer for a variety of reasons. If you want, you can roll over your funds to an existing IRA. Alternatively, if you don't already have an IRA, or if you would like just to move the funds to a new account, you can open a new IRA and roll your plan funds there. Perhaps the most common reason people choose to roll over their plan funds to an IRA is to broaden their choice of investment options. Many plans restrict participants to a dozen or so choices. You may have experienced this in your own plan. While the investments offered by your plan may be sufficient for your needs, many retirement savers prefer to expand their investment options by rolling over their funds to an IRA. Once inside an IRA, there are very few restrictions as to what you can invest in. In fact, while your custodian may be more limiting, the tax code allows IRAs to invest in anything except life insurance, collectibles, and S corporation stock. This can really help you tailor your retirement portfolio to your specific needs. Another common reason many retirees choose to roll over their plan funds to an IRA is to consolidate their retirement savings. A study released by the U.S. Department of Labor reported that baby boomers between 1957 and 1964 held, on average, a staggering 11.3 jobs between the ages of 18 and 46. Sure, It's unlikely that you have 11 different employer plans, but you certainly could have participated in two, three, or maybe more plans over the course of your working career. An IRA can serve as a convenient collection point for these plans, leaving you with fewer accounts to keep track of and watch over. IRAs oftentimes offer more attractive withdrawal options than plans. With an IRA, for instance, you can generally request a distribution whenever you want one. If you leave your money in your old company plan or roll it over to a new one, you're stuck with the plan rules. Your company plan might be flexible, but it might not. Another big difference between company plans and IRAs on the withdrawal end is that there is no 20% withholding on IRA distributions. With IRAs, you can elect to withhold 10% of your distribution for federal income taxes, any amount more than 10% if you want to. You can even opt out of federal withholding altogether and have none of your IRA distribution withheld. Another nice thing about IRAs is that if you have more than one of them, you can calculate your RMD for each account, but take it from just one account. So, for instance, if you have one account that you really like or that it's earning a higher rate of return and you want to leave it alone, and you have another account you're less happy with, you can take the RMD for both IRAs from the one IRA account that you don't care for as much. That's not the case for most plans, though. The general rule for plans is that each plan's RMD must be calculated and distributed separately. There is an exception to this rule, however, if you have multiple 403(b)s. Here's an example of how this might work. Suppose John has three IRAs and his RMDs for the three accounts are $5,000, $3,000, and $2,000 respectively. That's a total of $10,000 that must be withdrawn. John can take the $10,000 from one IRA or any combination of his IRAs as he pleases. Jane, on the other hand, has three 401ks. Her RMDs for the three accounts have been calculated and they are $5,000, $3,000, and $2,000 respectively. That's a total of $10,000, just like John. The difference, however, is that in order to avoid penalties, Jane must take at least $5,000 from her first 401k, at least $3,000 from the second 401k, and at least $2,000 from the third 401k. She cannot combine the RMDs and take them from just one account like John can. Rolling over your planned funds to an IRA can also provide estate planning benefits, such as making it easier for beneficiaries after you're gone by consolidating accounts. On the other hand, in some cases, rolling your money into an IRA can be beneficial for the opposite reason. Doing so may allow you to split your account into multiple accounts, each left to a different beneficiary. That may be helpful in situations like the ones you see here. Some plans may not accept certain beneficiaries such as trusts. They may also not allow you to use customized beneficiary forms or allow your beneficiaries to utilize certain strategies such as disclaimer planning. Rolling your planned funds over to an IRA that allows for these options can resolve this issue. Finally, we come to the last point you see, preserving the stretch IRA. This is an incredibly important concept, but one that is often not understood. Another estate planning strategy to consider is naming a charity as a beneficiary of your retirement account. This can be especially powerful from a tax perspective. Here's why. If you leave your IRA assets to an individual beneficiary, like a child, they will usually have to pay income tax on distributions they receive. By contrast, if you name a qualified charity as an IRA beneficiary, the charity pays no income tax at all. That means the entire amount goes directly to the cause you care about. If your estate is large enough to be subject to federal or state estate tax, leaving part of it to a qualified charity reduces the taxable estate. The charitable portion qualifies for a 100% estate tax deduction, lowering or even eliminating estate tax. For many families, a smart approach is to leave retirement accounts, which are taxable to heirs, to a charity, and then leave more tax-efficient assets like a Roth IRA, life insurance, or after-tax savings to loved ones. This way, you maximize the value of your estate for your family while also supporting causes that are meaningful to you. When we talk about leaving a legacy, it's just not about the numbers. It's also about supporting causes that are meaningful to you. For example, UVU established the Student Emergency Fund in 2019 to support students facing unexpected financial hardships. The goal is to keep students enrolled and on track to graduate while building future stability and growth. By designating a gift, whether during your lifetime or through a beneficiary designation, you can provide that critical bridge for students who might otherwise have to choose between school and basic needs. A minimal amount of funding now, or as part of your estate, can literally change the course of a student's life forever. This is how financial planning and charitable giving work hand in hand, maximizing the value of your estate for your family while also lifting up the next generation through causes that matter most to you. For more information on ways to establish a legacy gift, such as through a will, bequest, trust, annuity, or IRA rollover, please visit uvgift.org. As you can see, there are a number of potential benefits of rolling over your planned money to an IRA. To review, those benefits may include a broader array of investment options, more flexible distribution options, RMD aggregation across multiple IRAs, more estate planning flexibility, and a simpler process for beneficiaries to preserve the stretch. When it comes down to it all of these things can be really summed up into one word: control. In general, an IRA simply gives you more of it. But they're not perfect, and as you can see here, there could be some downsides to making this move. All right, let's move on to our fourth option, simply taking the money out of your plan. This is often referred to as cashing out of your plan. In general, this is not a great idea because you'll have to add the distributions to your income for the year. You will also lose the tax deferral on those funds. Remember, while your money is growing inside of a retirement account, you don't pay taxes on any interest, dividends, or capital gains. Despite compelling reasons like these, an alarming high number of people still cash out their plan balances after they leave an employer. Now, I said it's generally not a good idea to cash out your plan, but that's not always the case. In fact, if you're lucky enough to have the right set of circumstances, cashing out your company plan might make a lot of sense. That's because there's a number of tax breaks, like the tax breaks for net unrealized appreciation, that can offer big tax savings. Before we talk about these strategies, though, let me first explain what a lump sum distribution is. A lump sum distribution from a company plan means that your entire plan balance is paid to you in 1 year. Your account balance must be zero by the end of the year. If not, it is not a lump sum distribution, and you won't be able to utilize the special lump sum distribution tax breaks. By the way, the year here is a calendar year, not 365 days. Your distribution also has to take place after you have what's known as a triggering event. There are 4 triggering events outlined by the tax code. They are 1, death, which really doesn't help you out very much, but still could allow your plan beneficiaries to take advantage of the special tax breaks we're going to discuss. 2, reaching age 59 and a half. 3, separation from service, meaning you've retired, resigned, or otherwise left your former employer. Note that this triggering event is not available for self-employed persons. So if that's you, I'm sorry, you can't fire yourself to make this work. And 4, if you are self-employed, however, disability is a triggering event. The definition of disability here, though, is pretty restrictive, so just be careful. Okay, now that we understand what a lump sum distribution is, let's talk about the strategies. We'll start with NUA, since it's probably the most common. Sometimes, company retirement plans, such as 401ks, allow you to invest retirement money in your employer's own stock. For example, if you work for ABC Corp, your ABC Corp 401k might offer ABC Corp stock as an investment option. If you decide to make such an investment, then any gain you earn on those shares inside the plan is known as net unrealized appreciation, or NUA, and is eligible for the special NUA tax break. At its heart, the NUA strategy is a tax move that, for a portion of your retirement savings, allows you to trade the ordinary income tax rate you normally pay on retirement account distributions for long-term capital gains rates. Given today's rates, this can be a savings of up to 20%. So how exactly does this NUA thing work? There are really just 3 important rules that must be followed, and we've already discussed 2 of them. The first rule is that everything must come out of your plan in one calendar year, and the second is that the distribution must take place after a triggering event. The final requirement is that your shares of company stock must be distributed in kind to a taxable account, such as an individual or joint account. They are not rolled over to another plan account or IRA. That's a common mistake, and if you do that, you'll irrevocably lose the ability to make an NUA transaction. If your head is spinning right about now, I wouldn't blame you. NUA is a pretty powerful strategy, but as you can see, it's also fairly complicated. You're probably not going to remember all the rules we just talked about, but that's okay. If all you take away from this part of the presentation today is that NUA is something you need to explore further, then you're still way ahead of most people. And if you're still not quite sure if this applies to you, let me simplify things by asking two questions. First, do you have stock of the company you work for inside your retirement plan? If the answer is no, NUA is probably not something you need to concern yourself with. Second, has the company stock you purchased inside your plan appreciated or gone up in value significantly since it was purchased? If the answer here is no, then again, NUA probably is not something you need to know about. If, however, the answer to both questions is yes, NUA is something you need to seriously consider as part of your planning. And as part of that planning, I'd strongly urge you to consult with a tax or financial advisor with specialized knowledge in this area. It's rare that company stock will be the only asset in your plan, and if that's the case, there are additional concerns that should be addressed. There are other special tax breaks available for lump sum distributions too, such as the 10-year averaging and pre-1974 capital gains elections. These are still lump sum distribution planning strategies, so the everything out in 1 year rule still applies. I'm not going to spend too much time on these today because they really don't apply to that many people, but I do want to make you aware of them just in case one or both of them could benefit you. Your takeaway here is that if you're eligible to take a lump sum distribution from your plan and you were born before 1936, or if you had money in your plan on December 31st, 1973, there could be additional tax breaks that you may qualify for. Before making your rollover decision, you should be sure to explore these. And of course, while these strategies can be extremely powerful in some situations, they're not for everyone. Here are some reasons why these might not make sense for you. Okay, it's time to move on and talk about our fifth rollover option, a Roth IRA conversion. While this is certainly not going to be the best option for everyone, it is an option everyone has, and it's one that everyone should consider. In a Roth IRA conversion, funds go from your plan to a Roth IRA. Now, it's very important to understand that this is a taxable event, meaning the amount you convert will be added to your tax return for the year. For example, let's say Jane has $100,000 in a traditional 401k and would like to convert it to a Roth IRA. We'll talk more about why she might want to do that in just a moment. If Jane moves forward with her Roth IRA conversion and converts a $100,000 plan balance, she'll have to add $100,000 of income to her tax return for the year, which will be taxable at whatever rate Jane happens to be at. Because this is a taxable event, it's always best to discuss this option with your tax and financial advisors beforehand. Now, at some point, you've probably heard that you should never pay taxes before you have to. That's a very traditional way of thinking, and while in many cases it may hold true for you, there are a number of reasons why you might want to consider a Roth conversion. First and foremost is the potential for tax-free distributions from the Roth IRA in the future. If you're over 59 and a half and you've had any Roth IRA for more than 5 years, then all distributions from any of your Roth IRAs will be tax-free. If you're over 59 and a half but haven't had a Roth IRA for 5 years yet, you can still take out any of your converted amount tax-free at any time. If you're younger than 59 and a half, other rules apply. For instance, suppose that Jane is 60 years old when she converts $100,000 to her first Roth IRA, and it grows to $300,000 by the time she is 70. If Jane wants to, she can take a distribution of the entire $300,000 and it will all be tax and penalty free. If Jane had needed money, say when she was 63, which is within the 5 years of opening her first Roth IRA, she could still distribute up to $100,000 tax and penalty free. The potential tax-free nature of the Roth IRA may also provide you with additional benefits, such as a hedge against tax rates rising in the future. When it comes to your retirement, there are a lot of unknowns. What will the market do? What will inflation be like? What will your tax rate be? And so on. That last one, taxes, is a major concern for many retirees. A Roth IRA conversion can help manage that risk by paying taxes at today's known rates. If tax rates rise in the future, tax-free distributions from Roth IRAs will be even more valuable. Of course, if you think your tax rate will be lower in retirement, then that would be an indication that maybe this strategy is not right for you. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact other things tied to your income. For instance, unlike supposedly tax-free municipal bond interest, tax-free Roth IRA distributions are not included in the calculation that determines how much of your Social Security income is taxable, so that can help minimize that expense. They can also help keep other costs tied to your income lower, such as your Medicare Part D premiums. Another big benefit of the Roth IRA, and one that many retirees find attractive, is that Roth IRAs have no required minimum distributions during your lifetime. So during your retirement, you can take as much or as little as you want. You're not forced to take anything at age 73 or 75 if you don't want to, like you are with your traditional IRA or employer-sponsored plan. That means your Roth IRA can continue to grow and compound tax-free for your heirs. That makes the Roth IRA a very intriguing vehicle from an estate planning perspective. And speaking of your beneficiaries, non-spouse beneficiaries like children, they will have RMDs from inherited Roth IRA accounts, but those distributions will generally be tax-free as well. Remember our stretch IRA example from earlier? Now imagine if all of that was tax-free. You probably know what I'm about to say right now. That's right. Just like everything else that we talked about today, this strategy, as you can see here, is not for everyone. All right, we've come to our sixth and final option, an in-plan Roth conversion. This is a relatively new option and is probably not available to all of you, but you should be aware of it just in case if it applies to your particular situation. An in-plan Roth conversion is similar to a Roth IRA conversion in that you take pre-tax money, pay tax on it, and then you have it in your account growing potentially tax-free for future use in retirement. The difference is that the conversion is made from the traditional side of your company plan to the Roth side of your plan. For example, if you have a 401k that allows in-plan conversions, converted funds would go into your Roth 401k account, not a Roth IRA. From a tax perspective, the impact on your tax return from a Roth IRA conversion and an in-plan Roth conversion are pretty much the same. You have to add the amount you convert to your income for that year, and if you meet certain guidelines, future distributions in retirement will be tax-free. So if you decide to make an in-plan Roth conversion after you retire, you're really making two choices. First, you're deciding that a Roth conversion makes sense for your tax planning over the long term. We've already discussed why that might be. Second, you're deciding you're better off keeping your money in your plan than you are moving it to a Roth IRA. If both of these statements are not true, one of the other 5 options we've discussed today is probably a better choice for you. A big disadvantage of in-plan Roth conversions is that even after the conversion, minimum distributions are generally still required once you reach 73 or 75. If you were 72 or older at the end of 2022, you should already be taking RMDs from your IRAs. For those of you who are still younger than 72 at the end of 2022, you'll have to start taking RMDs when you turn 73 or 75, depending on when you were born. As you can see here on the bottom of the screen, for those of you born between 1951 through 1959, you'll start taking RMDs at age 73. And for those of you born in 1960 or later, you'll start taking RMDs when you reach 75, unless Congress changes the rules between now and then. Perhaps the biggest drawback is that there is no way to recharacterize the conversion. So if your tax bill is higher than you expected, or your account value has dropped significantly since the conversion, or if you otherwise changed your mind, it's too bad. You're stuck with your in-plan conversion and the resulting tax bill. One of the major reasons many people consider Roth conversions in the first place is to avoid RMDs and to allow their money to compound tax-free throughout their lifetime. That's generally not going to be the case with an in-plan Roth conversion though. So if avoiding RMDs is important to you, a Roth IRA conversion may be the better solution for you. Okay, I promise. This is the last time I'm going to say this today. This strategy isn't for everyone, and it comes with its own unique set of drawbacks. As you've probably realized by this point, the decision of what to do with your money you've accumulated in your employer plan is a lot more complicated than most people realize. Let's face it, your retirement plan assets likely represent years and possibly a lifetime's worth of savings. Now, this is the time to protect and preserve those hard-earned assets, and that starts with making the right rollover decision. Few retirees are aware of all their potential options. Even fewer are aware of all the key issues surrounding those options, so you're already ahead of the game. Hopefully, we helped answer some of your questions for you today, but chances are that you may still have others, but that's okay. We are here to help answer your important questions, evaluate your rollover options, and design a strategy that's best for you and your family. Thank you again for joining me, and best of luck for your continued success. Thank you.